Welcome to Energy Law with Energy Law Prof. Today we're starting a series on some of the market failures that drive energy regulation. So why do we bother regulating energy markets? Why don't we just rely entirely on the free market? And the one we'll be talking about today is market power and monopoly. To get started, it may help to talk about some of the reasons that in general, in free market economies, we do rely on the free market. And that's because we think that relying on the free market, willing buyers and willing sellers, leads to all parties that participate in that free market being better off. So you can think about supply and demand in a competitive market, and for simplicity, without tax, without regulation, without market power. So think about something like the market for gasoline or apples. So on one hand, you have suppliers, you have the producers of gasoline that can produce it. And let's imagine that gasoline is selling for $3 a gallon. So any supplier that can produce that gasoline for less than $3 is going to do so to make a profit in the market. So if they can produce it for $2 and sell it for $3, great. They have $1 per gallon profit. Now in terms of demand, that's all of us who use gasoline. We probably demand gasoline at all different prices. So maybe some of us would pay even $10 a gallon because we really want to be able to drive or need to be able to drive. So even if it costs $10 a gallon, we would pay it. Others of us might say, like me, I usually bike to school. So I might say, you know what, I'm not going to buy this gallon of gasoline if I have an alternative unless it's lower than $3.50. And so generally we will get anybody purchasing gasoline who values it over that market price of $3. But both parties end up better off from that transaction. The supplier is producing something for less than $3 and getting paid for $3 for it, and the person who's buying the gasoline, to them it's worth more than $3 and they're spending $3 for it. So that's the theory of how these markets provide a benefit both to the suppliers and those demanding. Now in that competitive gasoline market, that means that both the buyer and the seller have a surplus. The seller's surplus is the amount over what it costs them to produce the gasoline that they receive. And so, there's some of those sellers maybe can produce the gasoline quite cheaply and so make a big profit on it. Maybe some of them, much closer to $3. Maybe they're producing it for $2.75 or $2.80, so they make a smaller and narrower profit. The buyer is also experiencing a surplus. Maybe some of them would be willing to pay $7, $8 for that gasoline, and they're only paying $3 for it. So they have a big surplus. Others of them, maybe like me, they say, you know what, I wouldn't buy this gasoline if it were $3.50, but since it's $3, I'll buy it. And so basically have a narrower surplus as a result. But in theory, both the buyers and the sellers experience a surplus. They both split that surplus that the market creates by allowing those willing buyers and sellers to exchange their money and services. Okay, so monopoly changes things a bit. And the reason is, if there was only one seller who was producing gasoline, even if that seller could produce gasoline profitably up to $3, they would probably want to reduce their output somewhat. And the reason for that is, if they go all out and produce even that last gallon that gets the market price down to $3, right? That means they get paid $3 for all their gasoline. Now, if they reduce their production a little bit, the market price will rise because there's only enough gas to go around. Those who value it most highly will get it, and so it will sell at a higher price. When they do that, that means that because there's one market clearing price, generally prices for gasoline don't vary too much. In this theoretical market, the monopolist ends up better off. So they forego some sales here, those last sales from those last buyers who really didn't value the gasoline that high, like maybe like me, only said it's only worth $3.25 to me, and they don't produce their last gallon of gasoline that might have cost them $2.75 to make. They say, you know what, we don't need to make that sale. We're going to sell less And when we sell less, we're going to make more money because that will raise the overall price for gasoline. And so the way that does is it basically gives them more of that surplus by raising the price that gasoline sells for. Okay. Now, a couple things that I want you to understand. One is that you can see that the monopolist is taking some of the surplus that previously belonged to the buyers at the previous clearing price of $3. Now, from a Calder-Hicks efficiency perspective, maybe that's not a problem. So a lot of economists might say, you know what, that's not such a big problem because at least somebody's getting that benefit. I mean, that monopolist is a company, they have shareholders, they have employees, they all get money, so at least that money is not disappearing. It's not like society is worse off, it's just that the buyers are worse off. But there is one thing that's undoubtedly a loss to everybody, and that's the deadweight loss from monopoly, which is to say, there were transactions here that could have happened that would have been beneficial to both parties that didn't happen because you had a monopolist. So the monopolist didn't want to sell that last gallon of gasoline, right, that it could produce for $2.75, even though somebody valued it at $3.25. That was a transaction that would benefit society because they wanted to reduce production so that the price overall would be higher. So what makes the monopolist different is that it's not just one of many sellers, it's the only seller, and so when it reduces its production, it raises the overall market price. If one, if we think about by contrast with a competitive market, if one gas station raises its price, everybody just goes somewhere else. It doesn't change the market price. But if a monopolist who controls the whole market reduces their sales, that means a higher market price, and the monopolist benefits from that. And so remember two impacts of reducing its production. One is that it gets more of the surplus. Maybe that doesn't matter if we don't care who gets the surplus, but the thing that does really matter and that society ends up worse overall for is that there's this deadweight loss due to monopoly, which is that there are these transactions that don't happen. Okay, so when you have a monopoly, when you have that market power, you get higher prices, you get lower production, and you get deadweight loss. And so you can think about areas where there is a monopoly. Sometimes it's a regulated monopoly. You could think about, electricity in some places that have regulated monopolies, or you could think of cable that might de facto, have a monopoly in some areas. You could be in an apartment where they only let you allow you to use one company. So those are some of the problems it causes. It can also cause things like price discrimination and poor service. Okay, so the reasons that happen are a little bit complex. So one is the poor service may be simple to understand. If there's nowhere else you can go for service, then there's really less of an incentive for that monopolist to serve you well. In terms of price discrimination, it's kind of interesting because remember we said, there were further gallons of gasoline that monopolists could have sold to people who only valued them at, say, $3.25 or $3.50. They could have sold them profitably to those sort of marginal buyers, but they didn't because they didn't want to lower the overall price because they were making so much money selling gasoline, a limited amount of gasoline, to those who really valued it very highly. Now, in theory, if you could find who the specific people were who wanted gasoline at $3.25 a gallon or $3.50 a gallon, you could say, you know what, don't tell anybody else who's buying at the market price of $4.50, but here's a gallon of gasoline for $3.25, or here's a gallon of gasoline for $3.50, and you could make a little extra profit on that. But that would be price discrimination, charging different prices to those different consumers. And that can be very annoying. I know, sometimes people don't like that about cable service, right? You call, if you really want the good price for the cable company, you have to show them that you're willing to wrangle for that price, and they'll give you a lower price that they don't give to everybody else. So that can be very annoying. In theory, some economists would say, well, actually, that kind of solves that problem of deadweight loss because then we do at least have those transactions taking place. So that's what's happening with price discrimination. So what are the market power problems? Well, we have too high prices. some economists may say that's not a big part of the problem. At least somebody is getting the money, but at least politically, that's often one of the big complaints about monopoly. Too little production. That's undoubtedly a problem when you have monopoly. You have restricted production, and that leads to deadweight loss. We see that there's bad service, that can be a problem, and price discrimination. Now again, some economists might say, well, that kind of solves the problem of deadweight loss, but it's also very annoying. It can create its own inefficiencies, and so sometimes we'll see regulations against that as well. One regulation you sometimes see is what's called common carrier regulation, which sometimes can require basically posted prices so that you don't have that kind of price discrimination available. Now, what are the solutions to these problems of market power? We'll talk about them throughout this course, but one is you can create competition. So if there was something that previously had monopoly, you can break up a company, you can introduce competition to a market. We'll talk about how we've attempted to do that often in electricity markets. We'll see that some markets can't really support that competition. So there are areas where even when we've tried to create competition in markets, there's parts of those markets that we typically remain monopolies. You could have government provision. So you can say, well, we don't want a private company having this monopoly over service, and so let's have a government company in charge of it. We'll see that that has its own problems. So the political process often can be very inefficient, short-sighted. That can create problems. Another is utility regulation. We'll do a lot of focus on that, which is, and you had a little reading in your book, Otter Tail Power. We'll see that having the government set the rates for the private company to charge, that can also create certain problems. That can create some of the same problems that we see in government provision of some of these services.